Hi everybody, this is Alan Ellman, the Blue Collar Investor. In today's video, I'm going to discuss the 10 most costly mistakes made by covered call writers and how to avoid them. I have every confidence that if you could master all 10 of these topics, your profit levels as it relates to covered call writing will be enhanced exponentially. So with that in mind, let's get started. Probably the most important thing to know, and one of the biggest mistakes made by covered call writers, is that you shouldn't get started until you're fully educated and experienced with covered call writing. Now, education means that you've got to read the books, listen to the DVDs, and learn every nuance involved in this great strategy. Once you have this background, you should gain experience by paper trading. That means practice trading with a hypothetical account. If you're going to make a mistake, let it be without it costing you money. For the average investor who has little or no knowledge about covered call writing, this process will take approximately 3 to 4 months. But it'll be well worth it. At that point, you'll then have years and decades to benefit from this great strategy. Next, let's talk about evaluating option returns, another mistake commonly made by covered call writers. Many are enticed by high premiums. This is a big mistake because a high option premium means that there's a lot of potential volatility in the price of the stock, and that volatility could be in a negative direction. So there's too much risk with a high option premium. What you need to do first is to set your goal. My goal is 2 to 4% a month. Once you set your goal, then do the stock selection process, not the calculations. This will keep you from getting enticed by high premiums. So remember, run your calculations and look at your option returns only after you've established a watch list of the greatest performing stocks in the greatest performing industries. So, while we're talking about stock selection, I think it's important to learn that just because you own a stock that's already in your portfolio doesn't mean that it's an appropriate candidate for covered call writing. Many might be and some might not be. What you need to do is expand your horizons. Do your stock selection for covered call writing based on sound, fundamental, technical, and common sense principles. Once you've screened your stocks, now you have a watch list. A common watch list for me would be between 40 and 60 securities. And then once you've established that watch list, at that point in time, you can run your calculations. So once again, make sure that you base your stock selection on those sound fundamental, technical, and common sense principles I alluded to, and not just keep it to the stocks that happen already to be in your portfolio. Now, another weak point of many covered call writers is that they don't decide on which strike price to use. They just automatically go to an out-of-the-money strike. The reason they do this is because they get not only option premium, but the possibility also of share appreciation. So it's understandable. However, there are times and certain scenarios where in-the-money strikes are more appropriate. For example, in bearish or volatile markets, or if the chart technicals are mixed as opposed to completely bullish, or if your personal risk tolerance is low. So what you need to do is evaluate each situation on its own merit, have an overall market assessment, and then once you've selected your stocks, then take the time to also select the most appropriate strike price. Next, we're going to talk about management, which is critical. Most covered call writers buy the stock, sell the option, and hope for the best. That's not the way to run the show here, folks. What you need to do is once you enter your position, you need to manage that position until either the option is exercised or expires, or if you close your position. And when I talk about management, I'm talking about the possibility of executing exit strategies. You should have a whole arsenal of exit strategies available to you in case the trade turns against you, or in case the trade ends up being much better than you anticipated. There are actually ways of enhancing your profits even if you've maxed out on that particular trade. And you'll find that information also detailed in my books and DVDs. So remember, once you enter a trade, your job isn't complete. You must monitor that trade. It won't take a lot of time, but you must monitor that trade until the position is closed. Next, earnings reports. Here's another big mistake made by covered call writers, is that they will write a covered call prior to earnings. Now, earnings reports can disappoint, and if they do disappoint, what's going to happen is the price of the stock can drop dramatically. One disappointing earnings report could wipe out your profits for an entire month. So the golden rule is never sell a covered call option if there's an earnings report coming out prior to expiration Friday. Now, along the same vein, there are about 70 companies that report same-store retail sales on a monthly rather than a quarterly basis. These reports act almost like monthly earnings reports and can be very risky. So I refer to these as banned stocks because they never should be considered in your covered call writing portfolio. You can obtain a file of these banned stocks from my website. Just look for the free resources links at the top bar of my web pages. Your choice of brokerages is also critical to successful covered call writing. When you're using this strategy, you're going to be executing a lot of trades. And it's important that commissions don't get in the way of the highest possible level of your profits. So you must use a good, solid online discount broker. Commissions should never, ever influence your investment choices. Now, once again, on that free resources link on my website, I have a file of good online discount brokers that have been recommended to me by our members or folks that have attended my seminars over the years. So feel free to download and access that file, and it gives you all the contact information to help you make the best selection for your particular situation. And just as you don't want commissions to influence your trade decisions, you also don't want taxes to influence your decisions. If possible, do your covered call writing in sheltered accounts. If not, well then you'll have to pay your taxes. But I wouldn't mind paying $1 million in taxes, because that would mean that I've earned between $3 and $4 million. So paying taxes is necessary for our society. If it could be avoided, wonderful, but the tax situation should not influence your investment decisions as it relates to covered call writing. Now, there is a strategy called portfolio overwriting, and that's for folks that have a portfolio of stocks that they want to hold on to for the long run. There is a way of using covered call writing to increase the level of your profits, but it's done in a slightly different way than traditional covered call writing. And once again, that information is detailed in my books and DVDs. Diversification and cash allocation is something we also must address as covered call writers. The guideline is no one stock or industry should represent more than 20% of your portfolio. And you should own at least 5 different stocks in 5 different industries unless you're using exchange traded funds. Now, ETFs are baskets of stocks that give you instant diversification, and many of them have options associated with them. Along those same lines, the amount of cash that we put in each position should be similar. For example, if you owned a $15 stock and a $150 stock, it wouldn't make sense to own an equal amount of shares because you would be so much more heavily weighted in the more expensive stock. So regarding the mathematics and calculations of how to compute this, that information again is detailed in my books and DVDs. finally, the system that we use should be time efficient and user friendly. I'm a big believer in setting ourselves up for success. If we had a system that required us to look up way too many things before we make our investment decision, ultimately we're not going to use that system. It would be too time consuming, we'd be ambitious at the beginning and then eventually fade away. So although it's critical that we use sound, fundamental, technical, and common sense principles, it should be user friendly. And once you master the system, as we use it in the BCI methodology, it really won't take that much time to use this system in a time efficient manner. And that will allow you to make your decisions in a non-emotional way, once again based on those very same sound, fundamental, technical, and common sense principles. So there you have it, folks. Those are the 10 most common mistakes made by covered call writers. Once again, if you master them, if you understand all the nuances involved in this great strategy, your profit levels will absolutely be enhanced to the highest possible levels. So I hope you found this video useful. I thank you for taking the time to watch it. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.